righty. Let's do the countdown and ba-da-da-da-da.
All right, welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. With me today is David Blake, CMT, here to discuss what happened in the market last week and what we should be looking for as we head into this week's market. David, how are you today?
I'm doing well, thank you.
Very good. Let's jump right in.
Okay, well, last week we had the second week of the Iran war starting, and obviously the market was swung higher and lower by headlines about what was going to happen with oil. The big headline was that the Iranians were going to stop any tankers from going through the Strait of Hormuz, and that caused oil, I think on Monday, to actually briefly surge up to about $120 a barrel as the market opened. The major averages in global markets traded sharply lower. So the Dow was down 800 points right at the open, I believe. And then we got a late day report from Trump saying that the war was very complete, pretty much, and his words. And that staged a vicious rally off of those lows. And this is what we're going to be seeing here for a while until we get this thing resolved a little bit. Anything that sounds like the war may be coming to a close a little bit earlier than later, you're going to see a big rally. Anytime they get a tanker shot in the strait or something like that, or they stop or some more bombings of oil facilities, you're going to see the price of oil spike up and then equities go lower. So that's one thing you're going to be fighting. In fact, that day when they said the war was almost over, the Nasdaq reversed and it was up 308 points on that day. So that was down like 2.5% and then rallied 1.5%. So these are big moves in the market. You don't want to miss the rally, but then again, are you comfortable with the market dropping, 1,500 points or 2,000 points every time oil goes up? So this is something you have to feel for yourself. But anyway, also on Tuesday, we had the International Energy Agency. They came out and said they could release oil reserves. The G7 companies met, and they said they're going to take all necessary measures, including drawing on some of their strategic oil reserves to stabilize the oil market. And that brought the price of oil down a little bit more. And then we started to get the major averages started to rally a little bit. Not much because there's still a lot of questions in there, but they finished mixed a couple of days. We did see midweek, we saw yields move up higher when we had the February CPI report came out. That showed that inflation was still sticky. And going forward, this week, we do have the FOMC meeting for March, which is going to commence tomorrow. And then we'll have the press conference from the Fed chair on Wednesday. That'll be coming out. And that will actually be kind of tricky because how are they going to look at this Iranian war? Are they going to look at it as inflationary, or are they going to look at it as something that can slow down the U.S. economy or global economies? And so do we raise for inflation or do we cut due to a slowing economy? So what Powell says at that meeting Wednesday afternoon probably is going to be very important. Okay, then we had, what was that? On Wednesday, we had a big rally in technology sector, and that was partly due to Oracle coming out with their earnings. That stock jumped 9.16%. And then I also saw a rally in the semiconductors. They were up another about 3%. In fact, they were the only major average that was up last week, I believe. I think it was up about 5%, something like that. So at the end of the week, with another spike in oil prices going into the weekend, we had the market sell off again. We had the major averages down for a third straight week. Actually, they made new lows for, that's a third straight week of a lower low for the week. And as you know, that our CTI, which is our kind of timing device, as long as the Dow Jones is making a new intraday low during the week, we extend the cycles out a little bit. So we'll see what happens this week. We're probably going to be a -6 on Friday, unless we hit the low today or we don't hit a new low today, and we just keep on rallying through the week, which I doubt. As far as the different sectors go, energy basically hit a record high last week. We also saw utilities close positive, but everything else was negative. Financial was one of the worst acting ones due to private equity concerns on that. It was down, 5% or something like that. Then consumer discretionary and industrial were weak. They were down more than 3%. Rising fuel costs also weighed on the transportation stocks. You saw the global jets ETF. It's down 15% over the last 2 weeks. And actually, that's fallen back to where it was last November of 2025. So you're going to see the airlines, I think today they're all up 3% or something like that, because they're hoping that with fuel costs may come down a little bit. They're also hoping again for a quick off ramp for this war. But We're not going to talk about that, but we'll see how that goes. All right. So anyway, so as the dust settled last week, we had the Dow Jones, S&P 500, Nasdaq down for third consecutive week. We are starting to see economic data beginning to show some of the effects of the Iran war. Like I said, this week we have the March FOMC meeting. And currently, right now, CME Group FedWatch projects about a 99% probability that the Federal Reserve leaves rates unchanged. We will be interested to hear what Fed Chair Powell has to say about the effects of the war versus slowing down the economy. Now, the technical condition of the market, it did deteriorate some more last week. We had most of the trend indicators like the MACD all there in bearish ground. We saw a rising ADX, which means the downtrend is strengthening. Momentum's negative pretty much. And we did see a couple of the indexes fall below 40 on that RSI. We talk about that if you see the 14-day RSI dip below 40 for a couple of days, that usually indicates that the major trend has changed from bullish to bearish or bearish to bullish. And that's something we want to watch. The stochastics, however, would show an oversold market. We really didn't see much of some of them are oversold, including the Dow Jones transports, but the other ones are only down to about 30 or so, which is not oversold. But offsetting that, we had the MarketEdge and S&P short range oscillator, the SRO. It closed on Friday. It's minus 7.87%. Historically, that has brought in buyers off the sidelines, especially professional money managers. They'll come in and scoop up some of the oversold stocks. I mentioned in Friday's letter that we could see an opening, the week start higher because it was so oversold on the SRO. And that may be helping today a little bit also. People were ready to buy. And when we got some good news this morning about letting some ships go through the strait, that was just like a double impact to this rally. However, except for that, I still think that we're going to see the major averages struggle a little bit. We did hit our initial price targets on the different indexes. The new downside target as of Friday for the Dow Jones is 46.3 to 46.5. That's not much below where we are right now. In fact, it was almost to 46.5 on Friday's close. So I think we are getting close to where we could see a bottom. That actually correlates with the 200-day moving average on the Dow Jones. So the secondary target for the S&P 500, I have 65.80 to 6600. We actually were getting close to that again on Friday. And then the Nasdaq target remains here at 21.8 to 22,000. And again, I think we were within 24 points of that on some point last week. So I do believe that we're getting somewhat close, at least if this thing resolves itself a little bit, we could see. I don't think we've seen the lows yet, but I don't foresee like a big 10% drop immediately, again, unless this thing extends on and we get some more bad news on this. As far as investor sentiment goes, we've really seen the bulls back off a little bit. We saw the retail bulls were lower for a sixth consecutive week. They hit their lowest percentage since August of 25, and that's 31.9%. That's below the historical average of 37.5%. So the retail investor are backing off a little bit of this. We also saw the professional money managers and hedge funds. They have their lowest exposure in equities right now, the lowest since May of 2025, right after the Freedom Day or the whatever it was that Trump announced in April. They're down to 67%. And just a couple of weeks ago, they were up to about 98%. So they're taking some chips off the table here. They'll have some cash to move in. One of the things that we're also seeing a lot of times at this stage of the year, you start getting these tax refunds that will help. That's one of the reasons why spring is such a positive couple months in here. And this little bit of this Iranian war may take a little off the table of that. If people are paying more for gas and inflation starts picking up, you may not see that big spending come in, which to me probably indicates that any of these rallies that we're seeing like today are going to be short-lived and not something that you can start to build on and follow through. So keep an eye on that. Don't get sucked in on something just because you hear some of these headlines, because they seem to change day by day. I'd also want to just mention real quickly, Goldman Sachs did a little article over the weekend, and they were talking about what happens when you have an oil shock. And I think this is important. We've had them in 74, 1980, 1990, and 2022. And on average, the median decline on those has been about 12% from when it happened till we got it fixed. However, the peak to trough, because generally when something is starting to happen and you start to pull down a little bit ahead of time, has been on average about 27%. Now, right now, we're only down about 4%. And the mildest reaction in the market to an oil shock was 17%. So you want to keep that in mind. Now, oil prices have gone up about 68%. That's a big move. And what Goldman Sachs was looking at, if we could end this probably within 3-4 weeks, then they think that would be a little bit of a modest shock. They would still have a target on the S&P 500 of about 6,300. If we can settle it this week, then we probably have already gotten this thing. We can start to see the market move sideways. But that's their initial thing. That'd be another 7% lower than where we're trading right now. So keep that in mind. And then if this thing goes 2 months or longer, that would suggest that oil would probably move up towards the $145 a barrel level. And then the downside, if that scenario takes place, would take the S&P 500 down to 5,400, which would be about down 20%. Now, keep in mind of this. So this market is not cheap. If it goes down to about 5,400, that takes the PE on the S&P 500 down to 16 times earnings, which is where historically that's a good point to be buying stocks and getting into the market. So I think the gist of that article would be that we talk a little bit about taking stocks. This AI thing is not going away. Semiconductors are going to be, where you want to be going forward when we come out of this thing. You may see some vicious rallies in these things. And the smart thing to play on these things, I've been in the market for 40 years, is sometimes you go in, I'm going to go here to this charts, and you look at something like, let's say this is the semiconductor ETF. Okay, you're looking at this thing. It peaked up here around 427, bottomed over here around 376. Not a huge move, but it's found support down here at this level around 373. Okay, now that would be an area where maybe you put an order in. You should also see there's a little thing in technical analysis where former resistance becomes support, goes through that. And if you look back here, that same area around 374, 775 is where the market ran into a peak back in October, November, and December, and it backed off of that. Okay, that's also the same spot, same area where this thing came down and found support. So that might be something where if you want to own some of the semiconductors, you put in a buy order into the semiconductor SMH around that area where you buy at least a half a position. That way, if it gets there and starts to head back up because everything gets resolved, you've bought some on weakness. If it goes below that, I would say that probably the next level would be over here where you had some resistance. And that also coincides with the 200-day EMA, which would be another place where if it breaks through this, then maybe you look to buy something here. You can put an order in around 345, 350, and let these orders good till cancel. And this is the kind of thing where when you have a market like this, where we could be down 1,000 points or up 1,000 points on any headline, you at least take advantage of these big swings. You don't want to all of a sudden get a headline like today. It says, we're going to let some ships pass through and we may resolve this pretty quickly. We have a 600-point rally and you decide that's it. And you jump in there and start buying. And then tomorrow it comes out and says, no one's going to support that grouping of countries that are going to pass ships through the strait. And then all of a sudden the market goes down 1,200 and you're stuck because you jumped in there. Just be smart about things like this and don't panic about it, because when things get worked out, the market will probably move higher. The economy isn't bad. We've got a lot of exciting things going on with the AI and semis and stuff like that. And you want to be, have exposure to that. So you find some of these stocks and go to the charts like we just looked at on the SMH and put some good to cancel orders in here. And that way, if you buy some at 376, you're still buying at $50 below where it was not long ago. And that's not a bad entry point. Then you can come back in here. And if it goes a little bit further, then you have your order in here around 345. You maybe buy some more. And at least that way you're picking up some good stuff cheap. And that would be something, the way you want to play this, rather than just say, I want to jump in when everything gets settled, or I want to jump out on every rally, something like that. Don't worry about these intraday swings like that. Just play the longer game and consider yourself lucky when you get the opportunity. If you have a 1,200 point down day and you pick up 50 shares of this SMH or something like that, and then we bounce back up, great. It goes down just a little bit lower, maybe you can add to that position. That's why you don't want to just throw everything in at one time. But say if you have a $10,000 you want to put in there, maybe you buy $3,000 at this level, then put another $3,000 in at this level. Goes below that, where that's not too good, but you'd still be buying stuff a little bit cheaper, and you're not totally invested with the 10,000 up here to say just 375 or something like that. And that's the way that would be the best advice I could give to you. And you'll find your stocks, and also you look in some of your stock watch lists, you can find stocks or ETFs that you like at this stage that you think are going to be good candidates to buy. And you can go to something like this. Let's just take a look at, we bring the stock in here. Maybe you look at this thing here, you got a gap from 84 up to this area. It came back, filled the gap, which they normally do. Today we're down again. So maybe you look at this AAOI, we've got a strong buy on the thing, and you look at that and you put an order to buy in here around 85, something like that. So use our second opinion for support areas. You get a list of stocks that are outperforming. They look good. And just look at the charts and see where a good entry point would be. Another little secret on these things is when you get one that's in a void, when we have our early entry buys, those are stocks that we've had that have already pulled back. So right now in the S&P 500, only about 50% are trading above their 200-day moving average, which is a very low percentage. Now you come over here, if you're looking for stocks that you may want to buy, this shows you on our longs and avoids. With that, we have almost 45% of stocks have been downgraded to neutral or an avoid. So you're gonna have a lot of stocks on here that you may own or that you may want to buy that are avoids right now. Those are the ones that you want to maybe look at as the early entry longs, so that when they start to come back, when the market starts to come back, you can put your buy ticket in right around where the buy stop is. Okay. So let me find one that's an avoid here. Okay, here's one like Microsoft. We have an avoid on Microsoft. It's below $400. I think it's a pretty good buy in here. It got below there, bounced up over it, and came back down. But if you're thinking about buying Microsoft, right over here, we have a buy stop. It's not an early entry buy yet, but when it does become that, what you want to start looking at is when it crosses above this buy stop. We have that is figured as a point of resistance where, all of a sudden you're probably going to be under accumulation. And that would be a point where you might want to see if it gets above 410. That's where you want to go ahead and buy the stock. And you'd be buying it, about $100 below the high. That's not too bad. It's still about 20%. As you can see on here, it's way overdue for a bounce. It's oversold here. Your stochastic down here at an 8. That's very oversold for this thing. And you're underperforming the market by S&P 500 by about 16%. So some of these stocks that you look at, like that here, even Broadcom, that's a semiconductor. I love the semiconductors in here. This would be one that you may want to look at also. It's not an early entry buy yet, but when it gets up around 342, which is only $10 higher than where we are right now on a $300 stock, that's not much. That would be an area where you'd want to probably start to buy Broadcom in that area. Also, you look at this, just been coming down here and finding support around the 200-day moving average. You look at the charts like that, and you go, okay, I don't know if it's going to go below that or not. It may go a little bit, but those are how you would use these to build positions on these big sell-offs if you're looking to buy some of these stocks. You probably don't want to wait for it to be upgraded to a long on situations like this, because you're going to miss a little bit of the turnaround. So this way you can nibble away and wait for it. Yes, you can see the thing improving, and that would be another idea of how you would want to use second opinion to put yourself in some of these stocks that are way oversold in this market. I think that's about it. Again, don't let yourself get whipsawed by these headlines, which is going to happen for a while. And maybe to listen to the information from Goldman Sachs, where they talked about when we've had oil shocks in the past. They're not something that, unless they go away real fast, and we're already into our third week now, it often will turn the market into a bear market. So be aware that still is a possibility. Goldman Sachs isn't calling for that yet. But again, they're looking probably, if we go past 4 weeks or so, you're probably looking at another 7% to the downside. And just be aware of that. So when you're trying to navigate these headlines, don't be suckered in and to buy everything on a 1,000-point jump in the market, because the next day it could be down 500 points. So that's how you want to be cautious when you're around these headlines.
All right. Thank you very much, David. That's it for this week. If you have questions for David or anyone on the MarketEdge staff, feel free to reach out by leaving a comment below if you're watching on YouTube, or send us an email to support@marketedge.com, and we'd be happy to help you out. If you are new to MarketEdge, your first 2 weeks are free. Give us a try at marketedge.com for finished technical analysis on over 5,000 stocks and ETFs. I think that's it for this week. David, anything else?
Yeah, I think that's about it.
All right. We'll catch you next week then. Thank you.